one Proposition 24 and the other Proposition 26. My colleague from the Assembly is with me, and we have decided that we'll do Prop 24 first, and I will chair that hearing, and then Assemblymember Portantino will chair the Proposition 26 hearing. However, I would certainly welcome you to make any opening statement that you'd like. I will begin by first welcoming everyone and thank our presenters for joining us today. We're going to be very straightforward. We're going to have we're going to hear from first the LAO's office. They'll be joined by representatives of the Franchise Tax Board, and thank you, FTB, for being here today to take technical questions from the committee. And we'll follow the LAO's presentation with testimony from a panel of proponents of Prop 24 and then a panel of the opponents of 24. And we will conclude with public testimony. I want to welcome Senator Alquist as well. And staff, of course, are here. All right, so let's begin, first of all, with an overview. Let's have, I'm sorry, my co-chair, Assemblymember Portantino. Chair, would you like to add some comments?
Yeah, thank you, Madam Chair. I think it's important that we're having this hearing and on both propositions, and I think regardless of your position, whether you're for or opposed, I think one thing most folks agree that doing things in the middle of the night behind closed doors with 4 or 5 people coming to these late night deals is not the way to do business. I think we saw that not having something vetted through committee process causes concerns on all sides. Accountability, benchmarks, things that would come to the light of day if something were vetted in public would improve the process. So I wish a hearing like this had happened beforehand, but I think it's appropriate to vet these ideas as much as possible, and I think the public demands that we do better. So thank you for co-chairing this event.
Okay, I concur with your comments completely. Let's have the LAO's office, James Nachbar, and Jason Cisney, the Director of State Finance from the LAO's office. So, welcome to both of you. James? Yes.
James, right?
Yeah.
Great. Hello, good morning. I'm James Nachbauer. I'm an economist with the Legislative Analyst's Office. With me today is Jason Cisney, the Director of State Finance. And yes, we're talking about Proposition 24 today. I have a handout that should be in your packet. It looks like this, which I'll be going through in the course of my talk. This should take about 10 minutes. So I want to start with sort of a chronological framework of legal changes to keep in mind for this, because 3 provisions of California's laws for taxing businesses changed recently as part of the 2008 and 2009 state budget agreements between the legislature and the governor. And under current law, these changes will be in effect by the 2011 tax year. Proposition 24 would repeal business tax law changes and, in general, would return business taxes to what they were under prior law. Before I get into the specifics of which aspects of law might be changed, I just want to give a preview of the fiscal impact. By increasing the taxes paid by some, but not all businesses, Proposition 24 would bring in around $1.3 billion annually by 2012-13. So what are these specific areas of tax law? They're quite different. The first is the use of operating losses. The second is the taxation of the income of multi-state businesses. And the third is tax credit sharing. So if you're following along in the handout, I'm on page 2 now. I've got 3 pages in here, one for each of these areas of tax law. And at the top of each is a table that lists prior law in the left column, current law in the center column, and the law if Proposition 24 passed in the right column. And you'll notice in all cases the law if Proposition 24 passed is the same as prior law. This page, and the first law change we're discussing, is changes to the use of operating losses. Under federal and state tax law, in a year when a business has more deductible expenses than income, the business has a net operating loss. Under current state law, a business with a net operating loss in 1 year can generally carry forward the losses to reduce its taxes when it makes a profit in later years. Also under current state law, and this is new, a business with a net operating loss in 1 year will generally be able to carry back the losses to reduce its taxes for the 2 previous years if those years were profitable. So, for example, a business that had profits and paid taxes in 2009 but had a loss 2 years later in 2011 may deduct its 2011 loss against its 2009 taxable income under current law. The business would file an amended tax return for 2009 and receive a tax refund. These mechanisms have been put in place in part to recognize that business income or expenses can vary significantly from year to year. If Proposition 24 passes, carry back and carry forward provisions would return to what they were under prior law. Now we're on to page 3, changes to taxation of the income of multi-state businesses. Businesses often operate in many states, and their income is a result of the interaction between activities in these multiple states. To determine how much of the income of a multi-state business is taxed by the state, California law has used a 3-factor formula that considers how concentrated a business's property, payroll, and sales are in California compared to the rest of the nation. Starting in 2011, under current law, and this is new, most multi-state businesses will be able to choose each year between 2 formulas to set the level of income California can tax. A business's 2 options will be, first, the 3-factor formula of property, payroll, and sales, and second, the new single sales factor formula, which is based only on the portion of the business's overall national sales that are in California. Property and payroll will not count at all under this option. So if Proposition 24 passes, taxation of the income of multi-state businesses would continue to be based on the 3-factor formula. And now to the third and final area of tax law. These are changes to rules for tax credit sharing. Tax credits can reduce a business's taxes. If a business has credits which exceed the amount of taxes it owes in a given year, it will have unused credits. Typically, these unused credits can be carried forward to be used in future years. And now a quick word on business organization. Many business organizations consist of a group of business entities, and this is called a unitary group if it meets certain conditions, such as operating jointly or operating under the same management. And while groups sometimes act as one entity, tax credits are given to individual business entities and not to unitary groups. A law approved by the legislature and the governor in 2008 allows a business with available tax credits to transfer its unused tax credits to another business in the same unitary group, and the recipient could use the transferred credits to reduce its taxes. If Proposition 24 passes, businesses would not be able to transfer tax credits to other businesses within their unitary groups. So in summary, if Proposition 24 passes, the 3 business tax provisions discussed in this handout will return to what they were before the 2008 and 2009 law changes. As a result, first, a business will be less able to deduct losses in 1 year against income in other years. Second, a multi-state business will have its California income determined by a calculation using 3 factors. It will not be allowed a choice here as to how its income is determined. Third, a business will not be able to share tax credits with related businesses, even if they operate jointly. If Proposition 24 does not pass, the 3 business tax provisions that were recently changed will not be affected. And finally, as I mentioned at the beginning, there are revenue impacts here. This proposition would increase state general fund revenues by increasing the taxes paid by some, but not all businesses. And we consulted with FTB in coming up with our estimate that by 2012-13, state revenues would increase by an estimated $1.3 billion annually, with smaller increases as Proposition 24 phased in during 10-11 and 11-12. Note, multi-state businesses would pay more than 1/2 of these estimated increased taxes as a result of the elimination of the single sales factor option. And finally, under the formulas of Proposition 98, a significant portion of Prop 24's revenue increases would be allocated to schools and community colleges. Any questions?
Okay, thank you. First, I want to welcome Assembly Members Bell and Gatto and Fuentes and Estande to our hearing. Why don't we have both panelists complete their work, and then we'll see if there are questions. So,
nothing else to add, just a few
all right,
questions.
Fine. Okay. All right, I misunderstood. Any questions of the panel? Pretty straightforward. All right. Then let's hear from the yes people. Thank you. Peter Fisher, Jean Ross, Eric Hines. All right, Mr. Fisher, you're first.
Okay.
I believe so. Good job.
Yeah, I'm Peter Fisher, and I'm a professor emeritus of urban and regional planning at the University of Iowa, and I have spent about the last 15 years of my professional life looking at the issue of state and local taxes and their effect on economic development. And I want to talk today primarily about the effects of these 3 tax breaks on jobs in California. When we hear claims of substantial job benefits from tax cuts, there's good reason to be skeptical at the outset for a simple reason, and that is that state and local taxes on business altogether, property sales, corporate income, account for only 1.8% of total business costs of operation. If we're looking at a cut primarily in the corporate income tax, the corporate tax in California is only about 1/6 of state and local taxes. So even if you were to cut corporate income taxes by 1/4, the overall effect is 0.07% reduction in the cost of doing business for the average business in California. And it's difficult to believe that that could possibly have much of an effect on business investment decisions, given all of the other factors like labor costs, productivity, transportation, access, energy costs that affect location decisions and that are a more significant share of total costs. The research that's been conducted over the past 30 or 40 years has done a pretty good job of sorting out just how important taxes are in predicting or influencing state economic growth. And the general conclusion is that these jobs effects are there, but they are quite small, and they are there only if you hold public services and other location factors constant. In other words, if a state could enact a tax break without any effect on public services, there would be some small effect on jobs. But in practice, of course, states have to balance their budgets. Services are cut, and we know from a variety of other research studies that public services are important to business and also affect state economic growth, particularly infrastructure, public safety, and, first of all, education. In fact, education level of the workforce has been the primary determinant of state economic growth in incomes, according to a Federal Reserve study from 1938 to 2004. Public services are also important in attracting workers, particularly in higher tech, higher wage sectors. They want good education for their children and other public amenities that the public sector provides. So if we apply this consensus research on the small effects of taxes on jobs to the California situation, of about $1.3 billion in tax cuts, we get at most a figure of 4,300 new private sector jobs per year if we could finance the $1.27 billion without cutting public services. But of course, we can't do that. The likely effect at the average cost of a public sector employee is the immediate loss of up to 22,000 public sector jobs, which means that these tax breaks, if allowed to stand, would have a net substantial negative effect on jobs in California, at least for the first few years. Beyond that, even that 4,300 jobs in the private sector are open to question given the effects, the long-term effects on growth from those substantial cuts in public services and what that does to the willingness of businesses to locate new facilities in the state, given the erosion of support for public education, if nothing else. So in conclusion, given the small effects of these tax breaks, small, if any, effects of these tax breaks on job creation, they are very expensive because most of the tax breaks will go to companies who are doing nothing different than they would have otherwise. And that's true of tax breaks at the state level across the board, according to the research that has been done and that's been summarized. So if most of the money is going to companies who would do what they are doing anyway, it becomes a very expensive way to create a very few number of jobs, and perhaps none at all, and at the same time to force larger job losses in the public sector through the need to finance those tax breaks. Thank you.
Okay, thank you. Welcome, Jean.
Thank you. Good morning, and thank you for holding this hearing. I'm Jean Ross. I'm Executive Director of the California Budget Project, and you have a background paper that we prepared in your packet, and I believe the sergeants just distributed a study that was released today by colleagues of ours in Washington, D.C., which looks at Mr. Swenson's research, as well as a chart from Massachusetts, which looks at what happened to employment and manufacturing after that state enacted single sales factor apportionment. And I think, again, it is quite at odds with some of the promises that you have heard and will hear about what that particular change in policy has done. Massachusetts has lost over a third of its manufacturing base since they enacted single sales factor apportionment. In fact, the company that pushed hardest for that change, Raytheon, eliminated most of its jobs in Massachusetts after that state passed single sales factor apportionment. I want to briefly walk through some of the top lines of our paper, as well as the Mazeroff and Tannenwald paper that looks at the Swenson study. With respect to the three tax breaks addressed by Proposition 24 and the background, elective single sales factor apportionment is not the norm. We would be the only state in the country to allow businesses to choose on a year-by-year basis how much of their profit ought to be taxed in California. So this is not a case of a change that brought California into alignment with other states, totally out of alignment, something where we would be unique in a way that I don't think is to the benefit of California. Credit sharing, similarly, not the norm across the nation. Federal government doesn't have similar tax policy. This isn't a case where we would bring our tax system into alignment with other states. NOL carrybacks, yes, the federal government, federal tax system does allow that. However, a minority of states with corporate income taxes allow NOL carrybacks. I think a lot of that has to do with the fact that states, unlike the federal government, can't finance deficits by borrowing to finance the deficit, and it's very destabilizing for states as a whole when they have to refund taxes that they actually had a check cash in the door spent in good faith, and those refunds will have to be made at times when the state is likely to be facing significant budget shortfalls. I think what distinguishes all three of these measures, but particularly single sales factor apportionment, credit transfers, is just how few companies would benefit and how large the benefits would be to those individual firms. Single sales factor, 1.2% of California corporations, according to estimates by the Franchise Tax Board. 9 companies would get more than $20 million a year from that. 80% of the cost of that policy change goes to 0.1% of California corporations, those that have gross receipts in excess of $1 billion. That's over half the total impact of Prop 24 right there. Credit sharing, even more concentrated impact, 0.3% of California corporations stand to benefit. 6 companies, which is 0.1% of California corporations, would get more than $10 million apiece from that change. $240 million would go to just 14 companies in California. And I think you all know what that would buy, how that translates into some of the budget proposals that are before you. NOL carrybacks, yes, a somewhat broader number of companies would be affected by that provision, and you will certainly hear from small businesses who will say that is a part. But again, if you look at where all the dollars go, most of the money goes to very, very large corporations in California. Interestingly, 40% of lost carrybacks, again, go to that $1 billion plus club. Largest beneficiary by industry are holding companies. And again, I think we don't hear about attracting holding company jobs to California. That's where 1/4 of the dollars would go from that particular provision. Swenson study, rapid, it gets convoluted. In my many decades of working on public policy and economic research, it is the most error-ridden, egregious, sloppy piece of research I have probably ever seen in my life. And I say that with due respect to the author, the proponents. It is, and to Dr. Swenson, who's sitting somewhere behind me. His data that he presents, he compares states that have enacted single sales factor to California and then makes claims about what might happen here. His employment data for the states he compares California to are totally at odds with Federal Bureau of Labor Statistics data presented for employment in the different states that he looks at. In the pre-single sales factor era, he says the other 5 states have lost jobs. Federal government says they gained jobs. There's a bit of a problem there. He uses time periods that don't align with what he's trying to test. And again, I can answer questions on this, don't want to use up too much time. He misidentifies the number of firms that would benefit from single sales factor apportionment. In Georgia, for example, he says 3,109 firms would benefit from single sales factor. The state of Georgia, in a study done for their tax agency, says that 12,426 corporations would benefit. Kind of makes you wonder what happened to the 9,000 companies that he didn't look at. Maybe they all lost jobs during that tax period. He never looks at what happened to employment trends in states that didn't enact single sales factor. So you don't know whether the changes that he's saying are attributable to that policy change represent the policy change or whether they represent changes in the global economy as a whole. It is not a peer-reviewed study. It hasn't gone through the typical types of review that academicians typically do if they want to publish their research in a journal, in a publicly available part. There are typographical errors, cut, pasting. I could go on and on and on. I think you'll see there are a lot of details there. And the authors of the Mazeroff and Tannenwald study did try to reach Professor Swenson repeatedly to ask him questions to clarify the data. He did not return phone calls or emails. Thank you.
All right, thank you. The last speaker in this panel is Eric Hines.
Yes, good morning. My name is Eric Hines. I'm a fourth grade teacher in Pittsburgh in East Contra Costa County, and currently serving on the board of directors of the California Teachers Association. And I'm not a tax person, but I can tell you that for us at CTA and for educators across the state, that when these tax loopholes were created over the last 2 years as part of the budget deal, that they were done so without the proper public hearing, and there was no public input done. And I believe they were done late at night and just kind of as a last-minute deal. And at the same time, during that period, $17 billion have been cut from education in California. That represents the largest cut since the Great Depression. And that meant that also that we've lost 16,000 teacher jobs in California. And this year, had it not been for the federal jobs bill, we would have probably lost another 16,000. And so while these tax loopholes don't actually guarantee a single job, a loss of another $1.3 billion to the general fund next year would, in fact, create more loss of real jobs, and those are, educator jobs and other public service jobs that has been mentioned before. For us, this is really an issue of fairness. It's not really raising taxes on corporations. What it's doing is trying to maintain the current taxes that corporations are paying, since they haven't gone into effect until next year. So I think everything else I was going to say has already been said, that this would save at least 25,000 public sector jobs, and I'll just leave it at that. And it's important for us. It's just a matter of fairness that everybody should be paying their fair share during this time of fiscal crisis that we're in and look to be in for several years to come. Thank you.
All right. Are there questions of this panel from, let's see, my co-chair?
Got one. Mm-hmm. Nobody mentioned nobody mentioned Missouri in relation to the single sales factor, because I understand they are the other state that has gone to the same structure. Do we have any information of how it fared or what happened in Missouri, or any
I think
positive, negative, indifference? Any?
And they've had it for a very long period of time. I will certainly get that to your staff later today. They are certainly not a standout, and again, it somewhat depends on what year you cut the data. And the last couple of years have not been good for manufacturing, for state employment, anywhere in this country. And I know a prior piece of research done by Mr. Mazeroff showed that states that had single sales factor actually had weaker employment growth than did states that had either the old 3-factor or what California had until February of 2009 of double-weighted sales. The data has gotten a little bit murkier the last couple of years, and that just, I think, has to do with the fact that the recession and its impact on certain industries. There is not as much of a clear pattern. However, historically, states with single sales have actually had weaker job growth. And again, you hear a lot of promises. I've been talking to colleagues around the country. In Pennsylvania, very recently, for example, U.S. Steel, Hershey, Pittsburgh Plate Glass came and lobbied their legislature to move to single sales. They ended up at 80% weighted sales. All 3 companies, shortly after their legislature enacted the tax change, announced very significant layoffs of workers in Pennsylvania. Conveniently, they waited till after the legislature had acted.
Thank you.
Assemblymember Fuentes.
Very good, thank you. This question is aimed at Ms. Ross, but anybody at the table could answer it. I imagine that, well, first of all, the information presented here makes it very helpful, I think, to the voters out there in terms of who would benefit and who wouldn't, and certainly the size of the firms and that sort of thing. So I think it paints a very clear picture. But I'm wondering in your analysis, or if there's anything that you can speak to that talks about the stabilizing effect, if any, as a result of the tax incentives. I understand that there's a real good case here to demonstrate that there isn't any economic growth potentially, but is there a stabilizing effect that they would have? And if you could quantify that in terms of jobs, would there be any saving of jobs and that sort of thing? And realizing that the voters have a choice to make, very simply put, it's more of a stabilizing effect that I'm sort of looking for, and I'm wondering if this would have any of that?
Again, nationally, certainly no evidence. You look at what's happened in certain states, and I'd be happy to provide some additional evidence there. And Dr. Fisher, I think, can speak to this too. It isn't clear. And I go back, and we've heard a lot the last year or two about the need to go back and do dynamic revenue estimating. And being old doesn't have a lot of advantages, but it has the advantage of having been around. The last time California went through a wrenching downturn, we heard a call to do that. And in fact, in the mid-1990s, in response to a bill authored by then State Senator Tom Campbell, the state did implement a dynamic revenue estimating model. And it was built, and any time you model, and again, Dr. Fisher will say this, you have to make certain assumptions. The assumptions were the assumptions of then Governor Pete Wilson's Department of Finance. So to the extent you brought a perspective of the world and how people react to tax policy changes, it was biased by that of the Wilson administration. I actually think they did an extremely good job. And what they found is that for $1 billion of static corporate revenue loss, you would end up at the end of the day missing $820 million from the state budget. So yes, there is some positive impact, but it is nowhere near the cost to the state. You will at the end of the day end up $1 billion translates into a net reduction of revenues, $820 million. I think their job number, and it's in my paper, was that you would see an impact on employment of, I believe it's 12 or 14,000. It's very, very small compared to, say, the Swenson study. Interestingly, they also found that most of the jobs would go to people who would move to California from other states, not to Californians.
When you say 12 to 14,000, you mean stabilizing the 12 or 14,000 jobs, or an increase?
The employment benefit associated with that is, and you really can't, anyone who tells you can say whether it's stabilizing, bringing in, not bringing in, is making claims that I think that there just aren't data to substantiate that. That's sort of if you economically model it, in a model that takes into account the fact that you have to cut state spending to give that tax cut, and what that, jobs will be lost there. At the end of the day, you might come out ahead. It's not clear where, who is that in the long-term benefit of the state if you take the money out of the University of California and thereby hinder the next great, person to come up with a technological development in their garage. It may mean that there are long-term, short-term trade-offs there. And I think another paper, and I don't know if it was in your background packet or not, that I would recommend to all of you, and it's just the result of several years of really high quality, if you want to see what good economic research looks like, and very readable, which is always a good thing. It's Jed Polko and David Newmark at the Public Policy Institute of California have come at the whole question of what's happening to business employment in California. Jobs are not fleeing California. You have new firms start, new firms die, some live and get big. Out-of-state companies move into California. California companies move out of state. Why? Because they want to seek access to markets. One of the firms, in fact, that's on the no side of this told the state of Oregon that why they had located a particular plant in Oregon was they didn't want to be on the same power grid as Silicon Valley, which makes perfect business sense. You do not want all of your major facilities. If the power grid goes down and you're in the tech sector, that's a problem. They were moving because they wanted to have plants that, in the event of an earthquake in the Bay Area that takes the power grid down, they could keep operations going. Businesses move for a lot of reasons. Most of them are far more, and again, this is Professor Fisher's area of expertise, most of them are far more important than taxes.
Could I comment briefly?
Certainly, especially on the part there about your experience and why firms would move. How much of this tax incentive, either there or not, is an incentive to stay or leave?
Yeah, well, I think that the reason that the tax breaks have little effect on growth, to me, implies they have little effect on job stabilization either, for exactly the same reasons. And as Gene was talking about, if you look at periods, what contributes to overall job growth in a state, the new firm formation and small business growth is a major part of it. And none of these tax breaks really benefit a new firm at all. They haven't been in business long enough to have any profits, so the net operating loss carry back is no help. The carry forward is, but that's not in question. They're not corporations in their initial stages, at least. They aren't going to be not even going to benefit from, they don't have to apportion income in the first place, and they don't have subsidiaries to transfer credits to. And I think it's important to recognize that this has been called, the repeal has been called a tax on jobs, but there's nothing in these tax breaks that ties them to jobs. You need not create a single job in the state to benefit from any of these. You could, in fact, if you were a large multi-state company with operations in many states, you could, in fact, benefit greatly from single sales factor at the same time as you close down a California plant and lay off 500 people.
Mr. Nestandi?
Thank you, Madam Chair. And just to pick up on that point, I guess the argument is, do taxes change behavior? Is there a point where taxes get so high that companies do leave? They do not. Is there, I guess my question to you, first question, is there a breaking point for taxes, or can you tax unlimited and there's no effect on jobs or how companies do?
Well, one statistic that I looked at was from the Council on State Taxation, which is basically a business organization that tries to assess the overall level of state and local taxes on business, and found that they were, in California, exactly the same percent of state GDP as the national average. So I think it's hard to argue that California is anywhere near sort of the upper end to begin with. And I don't know that there's a breaking point. I think the research shows that it's just it's a continuum. Maybe you want to avoid sort of sticking out as the state with the highest tax on X or Y. Just because of the visibility issue, but I don't think there's...
You don't think it affects behavior at all for companies? You don't think it affects
I'm saying
economics?
That it affects behavior, but because it is such a small share of total costs, it affects behavior of very few companies. For most of them, the other costs that they're taking into consideration... I agree, I can get to that in a second, but just to clarify this point, so you could double the taxation rate on corporations here, it would have no effect? No, I think it would have an effect.
Significant or insignificant in your mind, then? If you went from 9.8 to 20?
Well, I don't know that anybody's considering a doubling, but yeah, at some point...
I'm just trying to follow the logic.
At some point, you could see an effect, sure. Yeah.
Okay, to your other point, though, about other factors, and I agree, absolutely, there's other factors that certainly encourage those choices to employ here or not. You mentioned infrastructure, education, energy cost, and I think that's part of the broader problem in California, where infrastructure, it takes an average of 12 years to build an interchange. In California now, 2 years is construction. That's 10 years of planning, mitigation, planning. Back when Jerry Brown was governor, I'm sure it's probably half that amount of time to build your infrastructure. So your system, we're going the wrong way, and I'm getting to a point of where to put the money. In education, in all due respect to Mr. Hines, I'm sure he does a great job teaching. Most teachers do, but I think there is evidence that our education system has not done a stellar job, and that's why President Obama has come forward with some real good reform efforts, recognize the fact that we do have issues in our education system. Energy, I believe we're the highest cost state for businesses is regarding energy. So the question becomes, are you going to take money from corporations to put in to the state that I think is going the wrong way for a business climate? That you will argue these other factors are big, but we're not doing a good job in those other factors. So why would you take the money out of the companies? Corporations come and exist to employ people. They do well when they employ people and they make more products then. So I think to take money away from them to give it to a system that's not necessarily doing a great job, I think that's kind of the heart of the question here. And I would argue defer more towards the private sector creating those jobs and doing a good job, or allowing them to do that, as opposed to putting it into the system that I think has gone the wrong way. Thank you, Madam Chair.
All right. I'd like to welcome Assembly Members Cotto and DeVore and turn to Senator Alquist.
Actually, may I respond to that a little bit?
Yes.
Is that possible?
Briefly.
Just briefly. I just wanted, partly about the system in education in California. In fact, we are seeing a lot of growth in the system in California. And while I am more versed on education policy and certainly Obama's education reform proposals, I can say that in California here, that a good example of what the expenses are, the Quality Education Investment Act, the SB 1133, which has actually shown that these bottom decile 1 and 2 schools in California are showing great growth, but they also had extra resources put into those schools in order to implement the kinds of good and research-based reforms that they knew were necessary. So there is good, but you need to have the resources in the school, and you can't just keep cutting them and raising class sizes and having biology AP classes with 40 students in them and then expect them to perform.
Okay, thank you. Senator Alquist.
Thank you, Madam Chair. I'd like to take, well, first of all, as one who represents 1 million people in Silicon Valley, and I share a lot of this with Assemblyman Cotto, Assemblyman Bell, who are both here today, I'd like to take a look at the macroeconomics of the impact of Prop 24. And that would be to say that first of all, that revenues from high-tech, biotech, green tech, taxes they pay comes to the state to help fund education, health and human services, public safety. That we count on these companies to stay in California. We assume that they just will never leave. But the facts show otherwise. Many of the established companies, when it comes to establishing a manufacturing plant, and I'm not even talking about China or India or some other country, but I'm talking about other states, they choose to locate the manufacturing plants in these other states. So although the numbers, and I majored in mathematics and was a financial analyst at Stanford University, all the numbers might show that we still have a lot of companies here. Gee whiz, can you imagine how high those numbers would be if a lot of the companies chose to keep their manufacturing plants and other resources in this state, and particularly during these tough economic times. And I'm a former teacher, high school math teacher also. We have to look at the whole picture. And I've had many people who work in the high-tech industry say, you know, Senator, we are really sad that we had to leave the state or that we had to take some of our business to these other states. And I just needed to make that point.
Yes, Ms. Ross.
Again, I would point to the Colco and Newmark research, and they compared the impact on job changes for California and the other 49 states for the period 1992 through 2006. And what they actually found was that California lost a smaller percentage of jobs, 1.7%, due to outmigration of jobs than the nation as a whole, 2%. Most of the job loss in California was due to deaths. That was startups that thought they had the next best great idea that turned out not to be such a great idea after all. And again, we were fairly close to the rest of the nation there, 65%, 62%. In terms of contraction of employment, outmigration, California actually did better than the nation as a whole. And I think, again, happy to provide this to you or your staff. Excellent, very readable short piece released last week that I think should be on all of your reading lists.
And my closing comment is that, there's lots of different data, but if you're going to include new businesses and substitute that for some of the businesses that are leaving, your numbers and your percentages are going to be different. Thank you very much.
I wanted to follow up on that for a moment with Ms. Ross and Professor Fisher. The Colco study, the way you described it, ends at 06. My question is, are we seeing a different kind of phenomena currently? And could there be a difference in the kinds of sectors that these taxes will affect? In particular, Senator Alquist is concerned about, and so am I, about the high tech. And that seems to be where much of at least the push for the single sales factor came from. Is there something different going on with respect to the last 5 years and moving into the future, and with a particular sector more than others? I don't know.
Interesting question. There's a lot of debate if you read, I would say, the economics blogs and what's going on right now about what is happening in the economy, and I think the answer is great minds disagree and don't know. I think if you look at the industries that led this downturn, led is probably not a good word, is sort of in an adverse way, housing and financial services. The tech sector has held up somewhat better than the economy writ large. I go back and again to the early 1990s, and if you look at, we are here, there is a deja vu all over again quality to this. In 1993, some of the same firms who are going to come up here in a few minutes came and argued for the state to go from the old three-factor formula to double-weighted sales. They also, at the same time, argued for creation of the manufacturer's investment tax credit. They made a lot of promises about the jobs and the revenues that would be created as a result of that, none of which turned out to be true. And in fact, and those of us, and I was a staff member to the Assembly Revenue and Taxation Committee at the time, I think a lot of us thought, well, that's sort of a throwaway provision. There had been a study somewhat similar to Dr. Swenson's that the proponents of the manufacturer's credit presented, saying 300,000 manufacturing jobs in California. The bill that created that tax credit said if the state doesn't have at least 100,000 more manufacturing jobs after 10 years, it'll go away. Those that, I will tell you, we also, that's sort of a throwaway line. In fact, there were not 100,000 new manufacturing jobs in California at the end of the period the credit sunset. Interestingly, and again, because of the double-weighted sales was mandatory on most, not quite all industries in 1993. Franchise Tax Board originally modeled that as a revenue increase. It was a 2/3 vote bill. As of the last tax expenditure report that I'm aware of that FTB did that looked at that, instead of being a $5 or $10 million a year revenue gainer, which is what it was originally scored at, it was a $200 million revenue loser. I don't think that these industries, again, I think we've been around sort of similar claims from the same people before. I have no evidence to suggest that the outcome will be any different than it was in the mid-1990s.
Okay. Professor Fisher, if you wanted to comment at all.
Well,
close.
Yeah, let me just say one thing about the high-tech sector. There's been a lot of research on what does affect location decisions, particularly of high-tech. And they are the sector of the economy where quality of life, public services, and education in particular are most important. They need highly educated workers. So I think it's the sector where cuts in the budget that affect education and other public services are most likely, in the long run, to be damaging to the location prospects of California for that sector. I don't know of a differential tax effect other than the extent to which they sell in national and international markets. That would be the primary determinant of how much they benefit from single sales factor.
Okay. Thank you all very much. We'll now move on to the no on 20. Oh, I'm sorry. Oh, sorry, Mr. Gatto.
Thank you, Madam Chair.
Sorry.
Members of the panel. Do we suffer from a perception problem in California?
I think that's also a very good question. I have to say, I travel a lot. I travel around the world. I spent 6 weeks in India last year, which is a place that we're often compared and contrasted to. When you tell people you're from California, they're like, that's where I want to be. You know, their faces. I've traveled in China extensively. I've traveled in India. You tell people you're from California, and it is still the place that wherever you go in this world, that people say it's the happening place, it's where innovation happens. I want to go to the University of California. I think our reputation is better the further away from California you get. I mean, and that's always whenever I travel, and I'm a native-born Californian, product of the University of California, and it's always a wonderful thing to be.
They used to say that about the Rust Belt.
My mother moved here from Michigan, and she never said that about Michigan.
I'm talking, maybe.
She said the Rose Parade on New Year's Day was, why people come to California, is that TV image of...
That's my district, of course.
People in shorts on New Year's Day, and they're all coming from Michigan to move to California.
Sure. So I guess what I'm asking is, the data can be read one way or another, and I'm sure there's lots of different opinions about the data, and I do understand that at some point there are something that we would all agree are hard and fast facts and some degree of science to it. But what does this do to a message, just from a plain messaging standpoint? Does this say that California is going to be hostile to business?
Good question.
I don't think so. I think that because it doesn't raise taxes on businesses, what it does is creates further cuts to the revenue at a time when we're seeing a crisis in the state in revenue. And I think while we can argue about the taxes up and down, whether the effects of that, what the effects are, some of the real effects we know and that we've seen are the loss of real jobs. And we know, and it's just a matter of basic fairness, and I can even explain that to my fourth graders, that if you continue to cut revenues and you don't put revenues in, the schools have no other source of revenue. And if you cut the general fund that cuts Prop 98, the minimum base guarantee for schools, and that means higher class sizes and fewer teacher jobs. And for those students in the jobs and those students that are being denied access to the UC because of places or because they can't afford it anymore, and those places, this is their time. They can't wait for another 10 years and then repeat the second grade because they had 35 kids in the class. This is their time. This is it. So what I think it really says is that we're allowing corporations an unfair advantage while the rest of us will have to pick up the slack, and those are middle class taxpayers, and because somebody's going to have to pick up the slack.
I think I would say it's a way of saying that California is serious about balancing its budgets, and I am personally the most fiscally conservative person you'll ever meet in your life. I believe
That's your second superlative today.
I am debt free. You could go to, but I seriously, and there are only two ways to balance a budget. One is to cut spending, and one is to raise revenues, or some mixture of the two. And I think we can all agree that probably the most serious problem facing the state from a public policy standpoint are chronic budget shortfalls. And I think it's one way of saying we're serious about getting the state back on track to balance its budget.
So I guess the only concern is of course, that I think everybody on this panel, everybody in the audience, even the people that are about to testify, they understand that funding education, especially for the high tech industry in California, the entertainment industry, is very, very important. We definitely need an educated workforce as we go forward, but I think there is a potential concern out there that as you said, the closer we get to California, people tend to have a slightly less rosy picture these days. I guess the question is, does this send a message during these times that we're going to be, even if it's not correct, even if all the data goes the opposite direction, are we sending a message that California is taking a step that's hostile to business? Because in the long term, of course, if we don't have a business tax base here, if we don't have the healthy business sector, then I think education is going to suffer. Because as you noted with Proposition 98, it's a pie, and if that pie keeps getting smaller and smaller and smaller, there's less to go around. And the way that the concern has been expressed to me, which I think is valid, is that everything we do in Sacramento, there's always unintended consequences. There's always something in the long term that might not necessarily be thought about in the short term. And if we get this perception out there, whether it's correct or incorrect, that California is hostile to business, there is a concern, I think, valid, that in the long term we might end up hurting ourselves more than we help ourselves.
Well, I'd just like to say one thing. As an economist, I tend to have a lot of faith in the market, and the market will sort things out, and that the firms that pay attention to perception and not to reality are not the ones who survive. And in the end, it's going to be looking at the bottom line, the real bottom line, and not a mere perception or image that's going to make your decision for you.
Senator Alquist, you had a brief comment, and then we'll
Very
move on.
brief. I should have included it in my former statement, but I think on tax policy, the best thing we can really do is the sales tax exemption for manufacturing, and that double taxation, which is really what exists today in that area, should not exist.
All right. And with that, I'll once again thank the panel, excellent panel, for giving us a view on yes on Proposition 24. And I'll now ask the panelists who are no on 24 to please come forward. Mr. Swenson, whose name has been bandied about, Mr. Valderrama, and Mr. Carter.
Mr. Swenson was taking notes.
Mr. Swenson, Professor Swenson, we'll begin with you. You are the Leventhal Research Fellow at the Marshall School of Business at the University of Southern California. So go ahead.
Thank you, members of the Assembly and Senate.
You need to push the red button.
Okay.
Yeah, perfect.
Okay. Thank you, members of the Assembly and from the Senate who have come here in a special session. My name is Charles Swenson. I have a PhD in accounting and economics. I've been doing research on state and local taxation now for about 27 years. I've published quite extensively in economics journals on just this one topic. I've been at USC for 24 years, was on the economics faculty at Caltech prior to that. I was asked by the opponents to Proposition 24 to look at the economic impact in terms of repeal of these three tax provisions in terms of job loss and revenue loss. And so I was asked to address just one aspect of that, which was the single sales factor. And I'll speak to that and also speak to a corroborative study done by the Rose Institute at Claremont McKenna College. Just at the outset, speaking of superlatives, in my 27 years, I've never been subject to such a professional attack before, and I won't respond in kind. I just hope to correct a few things that were said. I have published what I think and considered pretty widely as a well-respected academic in this area, and I don't do sloppy research. There were some mentions about one of my numbers not agreeing to a Georgia number and that sort of thing. The database I use is firm-wide data. I don't have access to government data. So, for example, the Georgia authorities have tax return data, which have a bit more drilled down information than I was able to work with. My work was reviewed by my colleagues, and I don't think there's any sloppiness in it. And tried to make it as rigorous as possible as opposed to conjecture, so there's real economic theory with real equations. The other thing I'd like to speak to is that taxes are important. I have spent, again, 27 years studying this issue. The state and local taxes are actually, on average, about 15% of a firm's tax bill. When you look at corporate income, property, sales use, other fees, et cetera, that's pretty well documented. So a 1% number is really the impact of a corporate income tax, assuming that was paid by sole proprietors. They actually pay income taxes. So it's actually a pretty big number, and there's a significant amount of economics literature that shows that, including my research, that taxes really do matter. Let me speak to just a little bit to the research that I did on the single sales factor. There had been significant economic theory and a lot of conjecture that the SSF would actually attract firms to a state, increase the employment base, and retain firms, but there had been no empirical evidence. So mine was the first study to do that, and I examined 5 states which had recently enacted SSF and was able to prove, which I thought through a pretty good experimental design, that in fact they did increase employment significantly. And then I projected that to the California situation and estimated that California job growth would be about 144,000. Which is, in a time of high unemployment, is a pretty significant number. Also was able to look at the general tax impacts. I realize that the LAO and FTB look at primarily the direct loss in corporate income tax from a change to that method. What's important to also consider is the other tax revenue impacts. So if firms expand or locate here, they're going to buy more goods and services. They're going to hire more people. All those people are going to spend money. The firms are going to hire other people. That'll increase the income tax base, the sales use tax base, the property tax base, et cetera. So when you take that into account, there's actually a slight revenue gain from the enactment of the SSF, and that's what my study indicates. I can't speak to Massachusetts. I think there was some anecdotal evidence, but I tend to like to work in larger numbers and facts. Now, the Rose Institute at Claremont McKenna College looked at the broader impact of Prop 24, which also looked at the R&E tax credit and also looked at NOLs. As part of that, they actually corroborated my findings on the SSF. Now, in addition, what they found was just by examining what other states are doing, I think it's quite informative to look at their study. And by the way, we had distributed this study quite a while ago, and I think there was some brand new report which the proponents of Proposition 24 kind of released today, so we were unable to see any of that. Our studies have been out there for quite a while now in the public domain. And it turns out that the 3 tax provisions, which would be taken away by Prop 24, are actually more prevalent than has been suggested by the prior panel. 24 states have some version of SSF. It is the case that none of them have elective. They're all actually required SSF, which is in fact what I studied and projected would happen in California, assuming a required and not an elective SSF. Also, 10 of the largest states and 7 of our competitors geographically have some aspects of the Prop 24 issues. They've either got credit sharing, or they've got SSF, or they've got NOL, carry back and carry forward provisions. So those are kind of our economic competitors, and they're all doing that. I looked at the Rose Institute Claremont McKenna study, and the results seem quite sensible to me in terms of they corroborated my results and then added the impact of allowing the continuance of NOL carrybacks and extension of the carry forward and also credit sharing. And their projections were that should Prop 24 be enacted, we'd lose about over 300,000 jobs. And also in the general revenue fund, we'd lose a significant amount of tax revenue. Their projections were up to $1 billion. So again, just speaking as someone who's been working in this area for quite a while and publishes actively, I'm not retired. I think I'm fairly well respected by my colleagues. I think the facts are pretty clear that these, if Prop 24 is enacted, that there will be a significant negative impact on our economy.
All right, thank you. Our second speaker is Tim Valderrama, the Executive Director of TechNet. Welcome.
Hi, thank you. For those of you that don't know, TechNet is a bipartisan organization of tech companies representing the leaders of the industry in information technology, biotech, clean tech, e-commerce, and finance. I just want to bring up 3 issues before I get into the bulk of my testimony that came up in the previous panel's testimony. One, I think that Professor Fisher actually correctly pointed out that with tax policy, what you really want to do is not stand out amongst other states. If Prop 24 passes, we would actually be the only state of the 10 largest states in the country that don't have any of these tax benefits. And when you compare us to the western states, the only other western state that would have no other benefits, like California would if 24 passed, would be New Mexico. So I think it's pretty clear that we would stick out in the event that this measure passed. The second item is something that Senator Alquist brought up. I think correctly she has put her finger right on the pulse of what's happening here, and what she's talked about is you have to look at companies and jobs migrating not just on a whole company picking up and leaving the state, but in terms of where expansion happens. And actually, the PPI study that Ms. Ross cites in there does state that she's right that companies generally do not pick up whole stock out of California and leave. But what the study does indicate is that expansion happens elsewhere, and as she says as well, companies are born and die. And you know, the NOL provisions help keep struggling startup companies alive, and specifically the single sales factor, if it goes back to the 3-factor apportionment formula, puts us in a situation where expansion makes a lot more sense in other states than in California. The final piece I wanted to mention from the previous panel is the comments made by Assemblyman Gatto, and it's not just a matter of perception. I think Mr. Fisher made a comment after your statement that perception, you know, if companies are making decisions on perception rather than reality, they're not going to be very successful. I think we would agree with that. I would say that the reality in California is that companies have no way that they can plan or count on anything that the state of California does. Just in recent years, we've had research and development tax credits, the utilization of those put in half. We've had, you know, corporate understatement penalties. There's been, you know, the passage of some of these tax reforms that we think are beneficial, and immediately on the heels of the passage of those, we have an initiative that would roll back all those tax reforms. So the truth of the matter is, if you're looking at the realities as a company trying to plan years down the road, there's no way that you can count on what California has to offer. So having said that, I would say that California is one of the most vibrant technology centers in the country. We'd like to keep it that way. The tax policies you approve to help grow businesses, retain and create more jobs, and ultimately generate more tax revenues will help our companies play a major role in California's economic recovery. Repealing the tax policies, as Proposition 24 would do, takes us a step backward. With 2 million Californians out of work and an unemployment rate higher than almost every other state, we need to encourage job growth, not penalize it. Proposition 24 literally taxes new job creation, hurts major employers and small businesses, and it also stifles job growth in our most promising industries. At TechNet, we've watched for years as other states, the professor mentioned 24 other states have gone to single sales factor. We've watched as other states do that, and we've seen that they are effective in other states, these policies. They're proven. They have federal precedent in a lot of instances, and other states have utilized them, and and the professor here at USC and the folks at the Claremont McKenna College have pretty good data that indicates that those measures in other states work. So obviously we're relieved when California kind of joined the rest of the trend that's happening in the rest of the nation. The LAO has said on numerous occasions that if California does not adopt single sales factor specifically, we'd be at a big competitive disadvantage with other states. So, I think in the interest of time, I'll just go ahead and finish up here and say that the legislature passed these policies specifically to stimulate the economy. As I said before, we have millions of Californians out of work, the highest unemployment since the Great Depression, and this is the exact time to reverse course. I think that's why you've seen that in recent days, the Los Angeles Times, the San Francisco Chronicle, the Sacramento Bee, the San Diego Union Tribune, other papers up and down the strait with all political persuasions have come out and said that this is the wrong measure to take at the absolute worst possible time. So we can't afford to strip away these policies. Thank you very much for having me. I'm happy to answer questions at the end.
Thank you. Welcome to William Carter, who is the owner of William Carter, his company, chair of the board of the National Association of Remodeling Industry. Welcome.
Thank you. Good afternoon. My name is Bill Carter, and I am National Chairman of the Board of the National Association of the Remodeling Industry. I am the local chapter chairman of the Government Affairs Committee of NARI, as well as owning and running a small local business in residential and commercial remodeling. I appreciate this great opportunity to speak to you today about Proposition 24, because it's a measure of grave concern to us, not only just in the remodeling and construction industry, but more broadly to business in the state of California. It's never been easy running a small business, and in my 35 years on the ground, this has been the worst year I have ever seen. Last year, I personally experienced a devastating 70% drop in business, as well as letting 17 people go, which is the first time I let people go in my tenure of 35 years. We're down to only 5 employees now. The story's happening up and down the state and throughout the nation. Times are tough nationwide, but California's been particularly hard hit. In 2009, 1 in 4 small businesses were forced to lay off employees, and bankruptcies are up by 81% over last year alone. More than 2 million Californians are out of work at 12.4%. That's the 3rd highest unemployment in the nation. UCLA's Anderson forecast anticipates we'll remain in the double digits through 2012. As for the construction industry, last year was the worst year on record in California. As one of their economists summed it up, the only good news is that it's hard to imagine it could get any worse. On the bright side, however, small business finally got some good news when the legislature threw us a lifeline, the ability to carry back net operating losses 2 years. I worry that might sound like dull tax jargon and that its importance might be lost. So allow me to put it this simply. For a small business, it can literally mean the difference between survival and closing up shop. What exactly does it mean to spread out our net operating losses? It means we can level out our income over our own natural business cycles so that we can be taxed at our average profitability over time rather than be taxed out of business altogether. Federal law has long permitted the 2-year carryback and the 20-year carry forward. In fact, federal law further extended that to 5-year carryback in 2008 and 2009 to help with the recession. So not surprisingly, small businesses are extremely concerned about Prop 24, which would repeal the important net operating loss provisions you all approved. Of course, Prop 24 goes even further by also repealing 2 other important tax changes the legislature made. It would increase income taxes on multi-state companies when they build new facilities or hire new workers here. Prop 24 would also prohibit affiliated businesses from sharing tax credits within their own unitary group. Repealing these much-needed tax reforms would not just hit California businesses, large and small. It would come at a great loss to everyone in the state. The Rose Institute of State and Local Government at Claremont McKenna College found that Prop 24 could cost the state as much as 322,000 jobs and $1.8 billion in lost tax revenues next year and for future years to come. There's a lot of decision about how Prop 24's job tax would hit some of the state's largest employers with higher taxes and the resulting job losses that would ensue. I hope people will also realize the problem it will cause for small businesses. Small businesses generate more than half of the state's private sector jobs, albeit it takes a lot more of us to do it. Our fear is that Prop 24 would leave a lot fewer of us standing to continue to provide those jobs and to provide the tax revenues, that fund our schools, that fund our infrastructure, and many other public services that need addressing, not to mention the state budget deficit. The National Small Business and Entrepreneurship Council ranks California near dead last on their Small Business Survival Index. 48 other states have a better public policy climate for small business. It's our desperate hope that Prop 24 will be defeated, so the tax changes the legislature approved will have a chance to help small businesses pull California out of the recession. I thank you for your time today on this important matter.
Thank you, Mr. Carter. Assemblymember DeVore.
Thank you, Madam Chair. I have a question for both Professor Swenson and Mr. Valderrama. In listening to the prior testimony from Professor Fisher and Gene Ross, I was hoping to get your comment on a couple of things. Number one, there was a study that was cited that purported to rebut some of the the findings of your own study and of the CMC study, which is a graduate of Claremont McKenna College. I'm happy to hear it constantly cited by the two of our witnesses. The study, I guess, compared a number of states from 1992 to 2006. And what struck me about that time period is that you have 9 years of the study that kind of led into the whole post-Cold War tech boom. And then you have 6 years of that study kind of after the tech crash hit California right around 2001. So also that time period, it seems to me, encompassed a period of time in which competitive states may have been altering their tax policies to try to improve their competitive situation vis-a-vis California. So I was wondering if you could comment at all as to the time period in question from that study that was cited that was used to rebut some of your presumptions, 1992 to 2006.
Yes. Thank you, Mr. DeVore, and I'm glad you like Claremont McKenna College, and I'm glad we share a name. I do agree there was a lot of dynamics going on in the economy at that point, and one thing that's really important in designing a scientific study is to try to take into account macro and micro changes that occur, and as I mentioned before, it's not my style to attack others, and so I'll just speak to what I think is the strength of what we did at USC and Claremont McKenna College. We use what is well accepted right now in the field of economics in what's called program evaluation to look at what's called a differences in differences methodology, which allows for very specific trajectories in individual firms' growth, and to take that into account. And so our studies are among the very first ones to have very specific firm-level micro data to do that. So that takes into account, along with those other macro factors, what firms' trajectories are in light of all of these exogenous shocks that occur, switching to a more high-tech economy, coming out of the Cold War era, and those sorts of things. So again, in summary, I think it speaks to the strength of our studies, and I would just prefer not to say anything negative about their study.
Well, the thing that struck me in listening to that time period is that if you look at a 15-year period of time during which the majority of time was when California perhaps had different tax policies relative to its competitors, and we were leading the tech boom, versus a 6-year period from 2001 to 2006 when things began to go south. Of course, if you take that entire 15-year period into account, you may look better relative to your competitors. What if they only took the last 6 years? That's kind of where I was going with it. If we only studied 2001 to 2006, I think the story may have been different. Regarding the elective single sales factor, which is vice chair of the Revenue and Tax Committee in the Assembly for the last 4 years, I have some knowledge of. I wanted to seek comment on a specific anecdotal tale that I recall from one of our hearings, where Genentech talked about why they located a $250 million manufacturing facility. Now, in this case, we're not dealing with the R&D where you're necessarily worried about the research institutions, but you're dealing with actually making the product that's been oftentimes invented in California. They located that $250 million facility in Oregon, and they did so because without the single sales factor, they were able to save, as I recall, $2 million per year in California taxes because it diluted their the base of property taxes. It diluted their payroll tax being paid in California, so they actually could reduce the overall corporate income tax in California by expanding their presence in Oregon. And had we had an optional single sales factor, it seems to me that $2 million per year savings would have been taken out of the equation. Perhaps Mr. Valderrama would want to comment on that.
Sure, I'd be happy to. I think there was some discussion about, earlier on about companies making decision on a number of factors, including tax policy. I would say that is true. I would also say that most of those factors California isn't doing very well in right now. But having said that, part of the tax formula of that decision is huge. And Genentech has said in numerous occasions in the public that single sales factor was the main reason they moved to Oregon. And I will tell you that is really the kind of perverse nature of the old three-factor apportionment formula. Is not only is it a tax benefit, not only are you hurt by expanding in California, but when you move out of California, your tax liability in California goes down.
All right, Mr. DeVore. Mr. Portantino.
Yeah, I have a question and then a comment if I could follow up after the question. Obviously, the legislation that drafted these tax policies is done and implemented, and the initiative is on the ballot, which will be dealt with on Election Day. After that's over, we're going to be entrusted with, crafting tax policy going forward, and what changes are necessary or not necessary. How do we stimulate the economy? Obviously, jobs are a critical concern, and it seems like what a lot of the discussion here is based on is what is creating jobs, what's not creating jobs, and whether this is effective. And one thing that I'd like to know from the economist's perspective is, going forward, to sort of take the argument off the table, would it be better to craft tax policies that are incentive-based, that you would actually have to show the job growth or show the economic benefit and then work backwards to actually receive the tax benefit once you actually have accomplished the goal? With the entertainment tax credit, you actually have to make the movie in California and actually have to create the jobs in order to qualify for the tax benefit. So as an economist, would you have a problem with crafting legislation going forward that actually had accountability, benchmarks, goals, and tied the benefit to job creation as just a policy question?
Not at all. I think actually that sort of accountability measure has actually been used significantly when it comes to more targeted tax incentives to when a particular firm wants to locate in a particular jurisdiction. Very often, cities and counties, through economic development groups, will craft an agreement that hits certain thresholds as part of an agreement. So when it comes to more specific things, that's been used quite extensively. And in fact, many states have gone to clawback provisions where if they don't meet those targets, they have to come back. It's not common right now when it comes to more general tax policies, which we're talking about right now. As an economist, I see nothing wrong with that so long as it's carefully crafted. One thing to take into account is that, for example, if we enact SSF for a particular company, and they move X jobs here, or alternatively, we enact it for them and they've got X jobs here, and we kind of presume that they're going to increase headcount by a certain other percent. One thing which such an agreement would have to take into account would be were there offsetting business conditions or economic conditions that caused them not to be able to do that. And so the appropriate benchmark was, did they not shed jobs relative to other companies? So it would have to be very, very carefully done to do that. And the other thing is just the increase in administrative burden from the government side as well.
Well, you actually stimulated a follow-up question. So as an economist, to expand the economy, create jobs, would you favor those targeted tax incentives and tax measures, or the broader ones that we have before us today? What would you, if you were king, what do you think is the better way to stimulate jobs in the economy? Targeted tax credits with benchmarks, or general tax measures without them?
I think, and this is not to hedge on the question, but I think over time we've seen that both of them can be pretty effective. The more general credits work better in the sense that there's sort of public knowledge of these things. There's less paperwork, and so for mid-caps and smaller firms that are unable to do the paperwork and those sorts of things, they've got something that they're certain about that doesn't require a lot of paperwork and that sort of thing. And so these more general incentives would certainly be appropriate. And also it gets back to the signaling about what you're doing to the state, for the state. The more targeted ones have been a time-honored method of being able to more surgically redress economic issues within the economy at the time. And so, for example, if we see, if it's our view that we want to increase green-based jobs or manufacturing jobs, then having those more surgical methods does give us another arrow in our quiver to be able to move the economy forward.
Okay, thank you. My comment is this: as I said in the beginning, we're going to be entrusted with crafting tax policy come January, after this is all settled, and something, if I'm blessed to stay as chair of Revenue and Taxation, something I've sort of challenged folks out there is that, think about the accountability, the benchmarks, the goals, and none of us, whether we're on either side of the aisle, if we know that something is going to return on an investment, if we're going to invest $1 and return 5 or 6 or whatever, or create jobs, I think most of us would agree that those are good things to do. It's how do we show definitive examples that we're being effective? And I think to folks who have not wanted to put the accountability to know which corporations get benefits, to know how it's related to the jobs, and I heard it earlier today that these aren't tied to jobs was one contention, to the more specifics and accountability and benchmarks and goals we can make it, the more justification we have to make these investments and help the economy. So I think to cut to the heart of the matter, and where there might be bipartisan support, is let's show the accountability to show that these are effective, and that way we can have the stability and the benefits that people have talked about. So I just throw that as a challenge, so when we come back in January, we don't fight those type of provisions, because I think it might help the arguments overall.
All right, thank you. I want to thank the panel for their testimony, and we'll move now to hear from the public. Thank you, all three of you. If there are members of the public that wish to comment on this issue, please come forward on Prop 24. Welcome.
Lenny Goldberg. We signed the ballot argument in favor of 24, California Tax Reform Association. And I will be very quick because your time is short, and we'll be here this afternoon as well. all this measure does is repeal tax breaks that were passed without the kind of hearing that we have had here today. And in doing so, none of the discussion and none of the justification of the opponents focuses on this question of elective single sales. And when we have had discussions in Rev and Tax and the De Leon bill, which eliminated the elective portion of it, it was very clear that what this policy does is that if there are ostensible benefits to single sales, it short circuits and cuts them in half, because out-of-state companies still can elect every year, and they can manipulate. When they take losses, they can attribute more to California, and when they take gains, they can attribute less. So that is a mistaken policy that is being repealed. The other discussions, we should have them at the Rev and Tax Committee. The second thing is, and just I'll say this about loss carrybacks, which has never been heard by any committee. Even when people had bills to do them, I remember they always took them out of the bills in advance of coming to the Rev and Tax Committees. Why? Not only is it budgets destabilizing, but it has no incentive effect. And I'll leave you with this thought. If this were in place in 2008, just as our budget was tanking and we were taking huge losses, we would have been writing refund checks to Countrywide. That is unacceptable as tax policy. Prop 24 passes, we're back to the drawing board and can have a very good discussion of future tax policies.
Thank you. Is there any further public comment on Prop 24? All right, then on behalf of my...
Sorry, can I...
Oh, sure. Come on.
Marie Schmidt was here earlier and had to leave and asked that I read this on her behalf. My name is Ted Green. She wrote this. I'm Marie Schmidt. I work for Counterfeit, a small countertop company. I apologize for having to leave, but I have to bid on a job with a possible $300 profit. That is the reality of a small business. Proposition 24 is simply about taking money that companies earn and giving it to the government. I own a pizza restaurant with my 2 sons. We work 7 days a week and we work hard. 2 of our employees were there to make money for college. Do you understand that? Kids are working during their high school years at small and large companies to pay for college. Then they work at corporations to repay college loans. I was involved with a group of corporations that refurbished the football and track fields at their local high school. Companies support education directly. Leave profits with companies, and they will lead us out of this recession. Thank you.
Thank you. Are there anyone else who wishes to address the committee on Prop 24? Come forward.
Yeah.
Welcome.
Hello. Well, thank you. I'm Randy Roth. I'm one of the owners of a small tax and business services. We have about 1,500 clients. About 200 to 300 of them are in small business, small and micro business. And I'll tell you that this proposition, despite what you've heard about some very large corporations benefiting, quite a few of our clients are going to be hurt by it. They will not be able to do the NOL carryback. We've heard about fairness. We've heard that it's okay for, and the fairness seems to be that this is somehow going to cut taxes for small business. These small businesses are already hurting. They've the average client I have that had maybe 20 employees is down to maybe 3 or 4. There are some in the building trades that you've already heard that the contractor himself is the only employee of his corporation or his business. If there was real fairness, it would be that other areas would also be cut the same way. Instead of, let's say, the budgets of households has been cut, the budgets of small businesses have been cut. Where's the budgets of the public sector? That would be fairness, wouldn't it? But so I think it's it's unfair to tell a business that basically, to say in California, you can lose $80,000 on your business, and you can't go back and average it like the federal government would allow you to average, and to use it against other income that you might have in the household. So the ones that oppose this, or the ones that are for this bill, are saying that you can't decide where the credits are going to be used, and they're talking about very large corporations. But I'm telling you, in the small household, that NOL carryback is huge. It could help reduce the taxes that a household pays on other income.
Okay.
So, okay, thank you.
Thank you very much. Would you all come forward and just have a seat? There are 3 of you left. Who else wants to testify? Anybody? All right. Then we have the last 4 here, and then we'll close the hearing. Welcome. Go.
Hi, I'm Mike Carpenter on behalf of the California Healthcare Institute. We represent 250 of the state's leading biomedical companies and academic research institutions. And our industry, the life sciences industry, employs about 275,000 Californians in good, high-paying jobs. And we strenuously oppose Prop 24. And it's not that we make light of the difficult fiscal situation that the state finds itself in. It's just that we believe the best way to solve this problem is to grow our way out of it, is to lure businesses to California, keep them here, have them expand here, and have them hire more people here. As we just heard from Dr. Swenson, these reforms will create hundreds of thousands of jobs and generate hundreds of millions of dollars. And we're concerned that Prop 24 would be a step backward, as we also heard from Dr. Swenson. Passage of Prop 24 would kill hundreds of thousands of jobs and cost the state hundreds of millions of dollars in revenue. And it would also put us out of step with the other states that are doing something to reform their tax laws. It would return us to the old regime where companies like Genentech were actually penalized for trying to expand their operations or hire and retain more employees. A pretty perverse disincentive. So with 1 in 8 Californians out of work, almost 12.5% unemployment, now is not the time to take a step backward. So we hope the voters will see through Prop 24, that they will stay the course, that they will oppose it, and we can give these just enacted reforms an opportunity to create jobs and generate revenues.
Thank you. We've certainly invoked your name enough.
Yes, hi. I'm Andre Jackson with Genentech, and since our name has been invoked a couple times, I thought I'd step up and talk about our expansion into Oregon. Mr. DeVore is correct. We did expand into Oregon, and the single reason that was cited to me by our senior vice president in charge of facility siting was single sales factor, and it turned out to be about 10% of the cost of the project. And like it or not, tax policy does invoke different behaviors from people, and it encourages or discourages behavior. And we didn't look at any state to cite this facility that did not have single sales factor, because our tax liability in Oregon remains the same because our sales remain the same there, and our tax liability in California actually went down when we built this facility because of the tax policy here. So it seems perverse that California actually paid us to build a facility in Oregon. And we're a homegrown California company. We'd prefer to grow here if we could, but we've gotten to the point where we're large enough that it just doesn't pencil out to do so anymore. With the merger of Roche, we have a lot of decisions ahead of us about expanding our headquarters in South San Francisco. Certainly we could expand some of those facilities elsewhere. Some of them are going to happen there regardless. But we need to plan, and we need to have a 10-year plan that we can rely on. And talking about, making these policies and then revoking them, doesn't help us to make those plans. And just to talk to Mr. Goldberg's comments for just one moment, if there are some tweaks that need to be made to these policies, certainly let's talk about those in the legislature and make those. But just simply repealing them with Prop 24 puts us in a bind where we can't plan and we can't expand here as a result. So I don't think repealing them is the answer to his questions about the policies themselves.
Okay, thank you. Next, please, and then
Madam and Mr. Chair, I'm Trudy Schaefer, the Director of Program for the League of Women Voters of California. I apologize that I've had to be in and out and missed much of the hearing, but I wanted to state the support of the League of Women Voters for Prop 24. Basically, when we have tax expenditures and other special tax treatments, we believe strongly that those changes from a treatment of everyone the same must be justified, and we believe that in this case it is a situation where there is no guarantee that in fact these measures that would be repealed by Prop 24 have in fact any guarantee that they will produce jobs. We do believe that when we're looking at the kind of budget crisis that we have, and I'm sure you've heard this from others, we are looking at horrible proposals for for spending cuts, and we shouldn't be relying on spending cuts alone, certainly not on spending cuts that are connected with tax cuts that have no demonstrable value. Thank you.
Thank you. And our last speaker. Welcome.
Andrew Governor, Governmental Advocates, on behalf of Bay Bio, Northern California's Life Sciences Association. We are opposed Prop 24 for the sentiments echoed by TechNet, by CHI, Genentech, new companies looking to site in California with the inconsistent policy of passing something and repeal it. I think we all know sends a message. Why would you come here? Because you don't know what California is going to do over the next 10 to 20 years. So with that, we respectfully oppose the proposition. Thank you.
Okay, thank you. That concludes the hearing for Prop 24. We will return at 1:30 for discussion of Proposition 26. Thanks to all of you who participated, the two fine panels and the LAO's office, and those of you that attended today. Thank you. We are adjourned.